Mahi. That's quite comprehensive with regard to the global setup and, opportune time to bring in Chidu Narayanan, who is the head of macro strategy Asia Pacific at Wells Fargo, to talk to us, of course, about how global macros are looking. First off, welcome, Mr. Narayanan. Let me first start off by understanding your view with regard to at least the US macro as well as the setup with regard to how the Fed is going to approach rate cuts. What's your sense? Is there enough bandwidth? Is there enough room? And how much are you anticipating in terms of a rate cut maybe over the next year?
Good morning, Harsh, and thanks for having me again. That's a good question and very important for global markets. The US, as ever, has remained pivotal in determining what markets do. Data last week was very comforting. US growth is still on very, very strong footing. There has been a couple of upward revisions for GDP growth, particularly coming from the consumer side, which is very comforting. PC numbers were flat, still high, but not accelerating, which is also comforting. We think the Fed will continue to cut rates. We've discussed this earlier, where we expect the Fed to be cutting rates at both the next consecutive meetings, and we still expect the Fed to be delivering 25 basis points of rate cuts at both of the remaining meetings for this year, followed by another 50 basis points of rate cuts, but at a more gradual pace in the first half of next year. It's important to dissect this. The Fed is not in a hurry to force substantial monetary policy easing through the system, but the Fed does want to get closer to neutral rates, which we think is probably around 3.25%. So by the end of the rate cutting cycle, the Fed would be close to the neutral rate. And this is more of a normalization rather than a cry for substantial monetary policy easing, which bodes well for the global markets.
And I'm trying to get to the fact that does the Fed have enough headroom? Because you've got tariffs that have come through. Likely inflation might inch up. Give us your view on that piece as well, because that's the big question mark, right? If inflation were to inch up, this could well throw a spanner in the works where the Fed is concerned and where rate cuts are concerned.
Absolutely. And I think markets have been focused on the inflationary impact of tariffs all year. We haven't really seen the inflationary impact of tariffs yet, and arguably that's because tariffs really kicked in only in July, August. The first half of the year was more bluster rather than actual implementation of tariffs. We do think that we will see an inching up of inflation in the US over the next few months, but the Fed would not be worried about increase in inflation. They would be worried about increase in inflation expectations. They would be worried about the anchoring of inflation expectations. So if it is a one-off, and I'm a little afraid to use the T word, transitory, which the Fed had been using all through COVID, which did not really end up quite well. But if inflation is transitory this time, then the Fed would be happy to look through near-term elevated inflation. Accelerating inflation is the worry, but we don't think it'll get quite there just yet.
Right. Chidu, I guess all eyes on the RBI itself here back home this week. Although they front-loaded with that 50 bips hike about a policy back, this time the anticipation is that they're going to go quiet and it will be a status quo. What is your own anticipation on what the direction from the RBI is going to be for the future, or rather remainder of the year?
Thanks, Aisha. I think that as well. I think the RBI probably stops for now, just pauses a little bit. They have maybe more limited space for rate cuts, but they can cut rates. It's a question of two halves. On one hand, you have substantial external headwinds. You have one tariff after another, which has been imposed by the US on Asia in general, India in particular, with the headwind from increased fees on H-1B visas, also negative, the increased tariffs on pharmaceutical imports into the US, the increased tariffs on auto imports into the US, all of that quite negative as well. And India also bears the sentiment issue. As you were discussing just earlier, we've had substantial outflows on the equity front out of India. In fact, in Asia, within the Asia context, India has seen the largest outflows, not just on a rolling monthly basis, but on a rolling quarterly basis, substantially higher than the next largest outflow that we've seen. So headwinds are aplenty. but domestic consumption is still generally strong. Domestic activity is held up quite well, and the RBI has eased quite aggressively as well. So there's enough space for them to wait and pause for a little bit. And this is where the data from the US last week, which suggests that growth is still quite steady in the US, is quite supportive. As long as global growth is all right, is holding up quite well, risk assets do well, cyclical currencies do well, cyclical markets do well, and that is where India should be a little bit more supported. And I think possibly the bottom for the INR is somewhere near, maybe not just yet, but it's somewhere near, which should give an opportunity for the RBI to stay a little while longer.
But Chidu, isn't that the big challenge or the question mark, whether global growth is going to sustain in Trump's tariff world?
That is indeed the big question. And that is where, again, the composition of the US growth is also quite comforting. It's not just that so you could have very strong growth, which could be one-off because the government is printing money and spending it, as happened in pockets in the global economy through COVID. This particular print from the US is more comforting because it's coming from consumers. And consumption is the bulwark of US growth, and that is more sustainable. That's also quite comforting. Also comforting is that despite all of the uncertainty, volatility from tariffs, it hasn't really scuppered domestic consumption too much. It is softer, but if you gently slice the US economy into multiple different parts, housing market is still all right, not dramatically strong, but it's not collapsing. The CRE market is still doing quite well. There is enough fiscal impulse that's coming over the next few quarters. Monetary policy is gently starting to ease. Inflation isn't running away. And the labor market as well, while there is definitely some slack in the labor market in the US, it's not collapsing as well. So all of that, the composition of growth is also very comforting. So near term, the bias is that global growth stays supported as things stand, but there's always the uncertainty of what happens with policy in the US, maybe more tariffs, maybe more services tariffs that hasn't really been there so far, maybe more geopolitical risks. These are uncertainties that we'll have to account for.
Well, absolutely. It's an uncertain world. Chidu, great having you today on the show, and glad that you could take time out.
Pleasure. Thanks, Aisha.